Hey, everybody, welcome to the May 2026 market update. We have some mixed signals this month, so let me jump right into the numbers. As always, we look at the 5 county area of Wake, Durham, Johnston, Orange, and Chatham counties. Now, new listings in May were down 5.1%, but year to date, we're still up 5.7%. But that is a change in kind of the trajectory where we had seen new listings coming up year over year for the last few months. So we'll see what that means in terms of the rest of the summer. There were some headwinds in the real estate market, really in the macro global economic market that could have had some impact here. But we'll keep an eye on that. Year to date, though, still being up on new listings is certainly a good thing. Closed sales in May were actually up 4.2%. So we're continuing that trend of having closed sales be up month over month. But of course, that's a lagging metric based on what was happening the previous 30, 60 days or so. So we'll keep an eye on that as we go into the summer. Year to date, we're up 3.2%. Not earth shattering, but as I've said before, as long as we're moving in that direction with closed sales going up, that's a great reversal of trend that we've seen really over the last 12 months. So we hope to see that trend continue over the next 12 months. Median sales price down 1%, year to date down 0.8%. This is great, as you've heard me talking for more than months, really for years now. The last several years, we need median price to stay somewhat flat. So if we're down 1%, up 1% for the year, somewhere in that range, I think is really healthy for our market, so that we can get back into an equilibrium where we have a strong foundation to see upward growth. Percent of list price received, 99%. So we're still not seeing tons of negotiating room. Depends on the location, depends on the price point. Real estate is back to being really hyper local right now. So different markets and types of products are going to have much different experiences if you're a buyer or seller. But just know market overall 99%, a little bit of negotiating room here and there, still plenty of houses selling over the asking price. So really just depends. Hyper local is the key here. Total showings during May were up 10.5% over May of last year. So that's good. We've seen that showing trend pick up really since the second half of last year. That trend is continuing. So that's good news, because again, that's a leading indicator. If showings are up, then we should see pending transactions going up. If we see pending transactions going up, then we should see closings going up. But all of that, of course, hinges on the new listings. So new listings were down. So we'll see how that impacts numbers in June and July in terms of the number of pending transactions. We need houses on the market in order to go look at them, in order to write offers, and in order to close on them. But more good news, the pending sales are up 8.8% year over year. Again, another good metric, meaning we should have healthy closed sales results in June. But hopefully this new listings being down is just a blip on the radar. And with some of the easing of the kind of global or national economic pressures, then hopefully we'll start to see the new listings starting to come back on the market. Inventory up 6.6%. I think that's the lowest percentage change we've seen in a long time, probably a couple of years maybe. Inventory had been so low for so long. And so we saw it really starting to climb up with big, last year we saw like 40, 50, 60% increases. As we talked about last year, we saw them come down this year into more normal ranges. And this, I would put that in that category of a normal range. Inventory going up slowly, just over 8,000 units for sale. For reference, last year at that time, it was 7,500. So about 500 homes on the market more this year than we had last May. Inventory level 2.8 months. Last year was 2.7. So very healthy market. What we want to see, what the supply of inventory doesn't tell you, is really how many transactions are happening. That just tells you what the balance is between inventory for sale and number of buyers in the market willing to make offers. So we're in a very balanced state from that perspective. We just need more inventory so that more buyers can jump in. All right, as always, we're going to jump in the time machine, look back at May 2019, the last real estate time period we had before COVID shook things up, maybe permanently, I don't know, but to give you kind of reference on where we are. Are we back to a normal, quote, normal, or are we heading that way? This gives us a good benchmark to compare against. So let's just look at the inventory in May. We had of 2019, 8,300 homes, and we look at the inventory this May, just over 8,000, not a catastrophic difference there. So, I mean, really less than 5% difference. But if you remember, if you were selling real estate back then, or if you were shopping for homes back then, you remember in May 2019, it felt like we had no inventory. It felt like if we just had more homes to look at, I could sell 15 more homes this month. There were lots of buyers looking and not enough houses for sale. And so we're still below that number right now. So I'll show you the chart in just a minute, but we really want to see, we have plenty of runway still ahead for our inventory to grow. So hopefully that will continue happening. Of course, it takes new listings for that to happen. So month supply of inventory back then, 2.3 months. Median sale price was under 300,000, so 297 back in May of 2019. If we extrapolate that out with normal, what I'm calling normal appreciation, 5.5% for our market, if we're just in like a really kind of equilibrium type state, we see 5.5% appreciation would be somewhat normal. That's higher than inflation, but it's not accelerated growth like we saw during COVID. That would just be kind of a normal, healthy price growth for a market like ours with so much inbound migration. But if we extrapolate that out since May of 2019, that would put the median price at 432,803. If you extrapolate this out one more year, so pull out your phone, pull up your calculator, and multiply this number by 1.055, that would be 5.5% appreciation on top of that. You're going to hit almost exactly the median price that we were at this month in May, 456. So what that means is if we can see prices stay flat for the remainder of this year, when I'm doing the May video in 2027, we're going to say, hey, we are now right on track for where we would have been had we never seen the 15, 20 plus percent appreciation that we saw for 18 or 24 months during COVID. So that's good. What that really means in a practical sense is that when a buyer is out there and they're looking at a $500,000 house, they say, you know what, that kind of feels like a $500,000 house. Prices make more sense now. If you were looking for homes in 2023, 2024, it still felt like, man, that $500,000 house feels like it should be $400,000. We don't see that as much anymore. Prices make more sense relative to the cost of everything else in the world right now. New listings back in 2019, 4,530 new listings, only 3,800, just under 3,900 this month. So still way down. If you look at new listings year to date through May of 19, just under 19,000 listings had hit the market. And we are just over 18,000. So we're just a little bit behind because, again, we were down this month. We had broke through and kind of crossed through that threshold of surpassing the trajectory of 2019 last month. But because numbers were down a little bit in May, 2019 kind of took the lead again. But we're not that far off, so nothing to be concerned about yet. Again, we're up year to date in new listings, but just something to continue to monitor as we go through the summer. We need those listings coming on the market. Closed sales, though, this is the one that hurts. 3,600 closed sales back in 2019, and you can see just 2,860 closed sales this year. So we are still dramatically below where we were back in 2019. Year-to-date closings back then was almost 13,500, and we're under 11,000 for 2026. So a lot of room to go to catch up to these closed sales, but a great start to get there is going to be getting more listings on the market. There are plenty of people who want to buy houses. We don't have a shortage of buyers right now. We have a shortage of inventory. So if we can get homes on the market, that is going to resolve itself in terms of the number of closings. We will start to eat away at that gap and eventually surpass these numbers, I believe, in the years to come. But got to get those listings. And then just for reference, new pending sales back in 2019, 3,567. And you can see the pending sales this month were 2,945. So still well below, which of course is fine. It tracks with where the closing discrepancy is. But it just means don't expect June to catch us up on closings. These pendings, of course, are a perfect leading indicator, almost perfect leading indicator on what we're going to see for closed transactions. All right, so let's jump in, just show you some of the charts for perspective purposes. So this one is, I guess, good for if there was anybody that was concerned about inventory spiking and inventory becoming a problem. Well, then this month quelled those fears. You saw the after a couple of months of like really sharp growth in inventory levels, we're seeing that balance off here in May. Although, again, I would argue and would argue with anyone to tell you we need inventory levels to be surpassing the 2019 levels right now. So we need this green line actually to go up above this blue line. We have probably plenty of room to go before we start seeing excess inventory that is causing a problem in terms of prices. So I'm very comfortable with where we are and believe we have lots of room to go. So if we see this line cross, this green line cross the blue line this year, that's going to be fantastic. What we do want to see, of course, though, is it maintain the same kind of shape here. So we want to see in the third or fourth quarter, inventory should fall off dramatically as it usually does. So we'll keep an eye on this, but nothing shocking here. Looking at new listings, this just shows you the year-to-date breakdown. Again, we had a little stumble in January, but then we caught up in February and have seen growth above and beyond 2025 numbers. But again, in May, we had another little stumble. So while we're still up year-to-date, didn't love the 1 month numbers that we looked at in May. But again, that is just 1 month. So we'll be looking at this in June, and we're hoping to continue to bridge this gap between the green bar and the blue bar, which represents 2019. All right, closed sales. This just gives you a view monthly. Again, we really came out stumbling. So if you watched the video back in January, I was a little surprised that numbers were as low as they were. There were a lot of signs at the end of last year showing that we should have a strong 2026. And we came out stumbling a little bit both in January and February. Came out stronger, and we started surpassing month over month, or year over year rather, in March from the 2025 numbers. Of course, we started facing some headwinds this year with the Iran conflict. Inevitably is going to have an impact on new listings and closings. As I'm recording this video today, it appears there is going to be some kind of reprieve here, a peace deal that's being signed, which hopefully will remove some of the global restraints we've had that are inevitably going to have impacts on our market. But anyway, as you see here, the month over month, we've been stronger since March. And if we look at the year-to-date numbers, you can see as of April, we squeaked by the 2025 numbers, and we are continuing on that trajectory in terms of closed sales. If we see a slowdown in the summer due to some of the impacts of the Iran conflict, then that will show up, by the time we get to August or September. My prediction is that we will still end the year stronger in terms of number of closed transactions, at least by a few percentage points. And while that's not much, anything in that direction, anything starting to bridge this gap between now and the 2019 numbers is important. There's no reason why over the next couple of years we shouldn't be able to move past that 2019 threshold. And then just looking at pending sales, again, this is our leading indicator for what is to come. And we are still well ahead of 2025 numbers. So as long as we stay in this range, I'm okay with that, because that gives us an opportunity to continue to improve year over year. We're not looking for everything to get fixed all at once. We just want to keep moving in the right direction. And so far, so good for new pending sales data. All right, let's look quickly at the new listings to closing ratio. So this is a ratio I like to look at that gives you kind of a snapshot indication of how do sellers feel out there? What kind of pain are sellers feeling? So this is how many new listings do you need to take in order to have a closing? This number in the beginning of the year, if we do it on a 12-month rolling basis, that's one thing. But if we're looking at it in a calendar year like we are here, it means less the earlier we are in the year. As we get through the end of the year, it really is telling us what that year has felt like for sellers. But as you can see right now, the ratio basically tells us that you have to take 17 listings in order to sell 10 of them. And if you're taking listings out there right now, or if you're a homeowner selling your home, you may start to feel this. You may be feeling it right now that, gosh, 7 out of the 17 homes that get listed aren't going to sell. That's a tough pill to swallow if you're a seller. And it means you've got to compete on things like price and condition, making improvements to your home, staging your home. It takes more to sell a house right now than it has in years past. And so I anticipate this number will continue to come down, but I would not be surprised if it ends up higher than last year. And what that would mean is just that it feels a little bit tougher to sell a home even than it did last year. And for those of you selling last year, you remember 2025 was not the easiest year to sell a home. So this just, again, gives you the snapshot of the pain that a seller may be feeling. Right now, while it's not terrible, we're not back to like Great Recession numbers where we were up over 2.0. This is certainly an increase from where we've been over the last decade plus. And because of that, relative to the last decade plus, it feels really bad, maybe even worse than the data suggests. But hey, the way you feel, that's your reality. So just be aware. And as a seller out there, it means you need to take the advice of your agent. You need to take all the steps to prepare your home and be one of the ones that is going to sell. All right, last thing we're going to look at here is the Housing Affordability Index. No movement from April to May. Still elevated compared to where we have been the last several years. I'll show you just quickly the chart of where we were and where we are now. Obviously, before COVID or during the early days of COVID, we had great housing affordability, meaning the median household was making way more money than they needed to afford the median priced home. But around the first or second quarter of 2022, we dipped below that 100 level, which is the baseline, meaning that the median household makes enough money to afford the median priced home. So right now at 89, what that means is that the median household is making 89% of what they need to afford the median home price. We certainly obviously want to get that up to 100, but this is much better than the 60s and 70s we've been in for the last 4 years. We will, of course, monitor this. There's way more than just interest rates and home prices that go into this. Wage growth matters. What inflation is doing, the cost of other things, all of that matters. And again, because we've had the headwinds from the Iran conflict, as that starts to settle, then it's going to take some time. But the cost of goods should come down. The cost of oil and gas prices should come down. All of that is relative when looking at housing affordability. So we will see where this number continues to go in the coming months and monitor how it's impacting our market. As always, I appreciate you watching. If you have questions, thoughts, insights, please put them in the comments. We'd love to hear from you. And until next time, take care.